finance and all we do here with economics. Urian Timmer with us. He's with Fidelity, and he's a global macro director, but far more importantly, Urian Timmer comes to us today from hallowed ground in economics. I really can't say enough the importance of this. The only equivalency in finance would be J.P. Morgan's mansion on Madison Avenue when he saved the nation in 1907. Urian Timmer, you are at Bretton Woods in the Mount Washington Hotel in the acclaimed Gold Room, breathing the same air as John Maynard Keynes from 1944. What they needed to solve in that room after World War II was fixed currencies. We now have floating currencies. Does that push away our gloom and our worry because we can recalibrate from what they did at Bretton Woods and what we've done through the years with floating exchange rates?
I think so. You know, the problem with the gold standard, at least from the views of the central bankers, of course, is that you always have your hands tied behind your back. I mean, just think about the Great Depression. The Fed had really no tools to fight that, and there were bank runs. And you know, when you look at real rates, they went to plus 10, plus 15%. I mean, it's incredibly damaging. And I think Ben Bernanke back in the financial crisis said, never again. And so we've been in the fiat world, as the crypto people like to say it, since 1971. But it's interesting how stable currencies really have been. If you look at the JP Morgan real effective exchange rate index for the US dollar from 1970 to now, so 50 years, including the whole fiat period, it's down 0.5% per year. That's the CAGR.
Right. I
mean, that's some devaluation, but it's not anything like what some people might think, like, oh my God, you removed this anchor from the dollar, it's going to crash. So negative 0.5% CAGR, I'll take it. That's pretty stable.
Urian, you invented let's talk about hollow ground, folks. Years ago, it was 82 Devonshire in the chart room, which Mr. Timmer invented for Ned Johnson. Urian Timmer, you look at the chart room of Fidelity, and that was founded on Ned Johnson, John Templeton, and John Bogle and the rest, their long-term optimism of equity investment. The gloom crew has been wrong for 20, 30, 40 years. Do you see any amendment to that optimism?
I do not. And as you know, I study charts, I study history. I look at kind of secular regimes, right? So if you take the S&P, or whatever you can call that index before the S&P existed, from 1780 or so till now, on a real total return basis, it's the CAGR is about 6.5%. The nominal is about 10, 11%. And obviously there's large swings, there's drawbacks and drawdowns. The market goes up only 60% of the time. So 40% of the time, the market's going against you if you're invested in stocks. But despite that 40% chance of a down market, if you stay in long enough, you're going to get that 10, 11% over the long term. And when I look at kind of the secular regime we're in, at least from a technical point of view, and I compare it to the last few secular regimes, 1949 to 68, 1982 to 2000, we are exactly on that point where those markets were. And while the bears like to look at the Shiller Cape in PE ratio, which is of course is as high as it was back at the dot-com bubble. Frankly, I don't think that's what investors are solving for. When I look at price to total cash flow, dividends and buybacks, on that basis, the market is valued at the same level as those other secular bull markets were at this point on their course, which suggests that we have another 5 to 7 years left. S&P could be at 8,000 by then. So I remain very constructive on the markets, even though we got this Fed liftoff dance that we have to contend with.
Urian, here comes the gloom crew. How do you then push back against all these people who say we've brought forward so much of the gains, and frankly, interest rates are so low that they don't have much room or any room to go much further down, which has been one of the tailwinds behind equities for the past 3 or 4 decades. What do you say to those people who say going forward, it's going to be a lower return regime in equities? What's your counter argument to that? There's
no question that that monetary policy has inflated asset prices. And all you have to do is really geek out and bring up the discounted cash flow model, and you can quantify this, right? Everyone has this sense, so bubbles this, bubbles that, Fed has induced a bubble, but you can actually quantify it, right? If you put in the discount rate of the discounted cash flow market, right, of cash flow model, so cash flow is in the numerator, rates in the denominator, and you can show, or at least I can show, that the nominal 10-year yield based on where tips are trading is about 100 basis points lower than it should be. That 100 basis points of reduced discount rate in the DCF model translates to 5 additional PE points of valuation. So you can clearly show the market's 25% overvalued, and if rates were to, or that the asset inflation is to the tune of 25%. I don't want to call it overvalued because that's a conversation that has really no answer. But if rates were to reset higher, which I do not expect to happen, but if they did, that would be a 20% decline in the PE. And I think that's how you can kind of connect the dots of what is Fed policy doing to interest rates and what does that level of interest rates do to equity valuation. So it's 25% asset inflation. The question is, will that mean revert? And I think that was kind of in the spirit of your question. And my sense is that it probably won't. I mean, rates will go up a little bit, I think. You know, we're going to have more fiscal coming, of course. The TGA has been drawn down. So I do think the debt dynamics will point to higher rates, but that's kind of how I come around with that.
Jurjen, just real quick here, on the flip side, do you foresee the Federal Reserve going to an era, especially if there's another disruption in the economy, of negative rates or further lowering rates beyond what people thought was the lower bound in order to continue its reaction function of keeping monetary conditions and financial conditions as loose as possible?
I don't expect that they will go to negative rates, but I do expect that, you know, after this liftoff dance, as I like to call it, of tapering and forward guidance and so many rate hikes in the next 5 years, it's only a couple, that the Fed will, you know, that we will stay in a low interest rate, high QE era. And all we have to do, and it's really very simple, all we have to do is look at what Japan has done. And Japan is about 10 years ahead of us in terms of its demographics. And, you know, the Bank of Japan, its balance sheet's 131% of GDP. It owns half the stock, the debt stock of JGBs. It is buying half the flow of incoming JGBs, so the supply.
Wow.
The Fed, by comparison, owns a quarter of the US Treasury debt stock, but since 2019 has been buying about a third of the flow of treasuries. And so if the Fed were to ramp up just the asset purchase side and keep rates anchored at zero, in 5 years or so, we might look more like Japan. And it's interesting, the long bond in Japan, so the long-term JGB market, has an annualized volatility of 3, which is extremely low. In the US, that the equivalent would be 11. And so it kind of brings me back to the 1940s financial repression. You know, the Fed kind of kept rates well below the inflation rate. I use that as a playbook. So US 1940s, Japan currently as kind of the two analogs to where we might be in 5 years.
Fascinating stuff, Jurjen, and just incredible stats. Jurjen Timmer there, Fidelity Investments Global Macro Director. Tom,